Welcome. The head and shoulders pattern. I'm going to show you how to take advantage of it. And to help explain my example, I have a NZD JPY trade for a 71.6 take profit, risking about 22.4 pips. And we will explain the head and shoulders pattern as well as it will apply to the inverted head and shoulders. So let's get into it. Now, I do have a video that explains the head and shoulders pattern. I will have it linked in the cards. It will be in one of the corners, so you can check that video out. But today, I do want to explain the head and shoulders pattern and what it essentially is. Why is the head and shoulders pattern a pattern you should implement into your trading plan and understand what's going on in the market? First, you have a level created in the market, and then you have that level broken above. So we call this the left shoulder. Once this level is created in the market, and then the market does break above that level, so we start to see the market break above that level. So if the market does break back below that level immediately, so I mean all the candles are necessarily the same color, or it's a clear impulse back down to where this candle almost started, or where this impulse up almost started, you can expect that the next move will be a move back up to retest this left shoulder. And then from there, that left shoulder is going to act as resistance because we had enough power to move back down and break below that area. We're going to come back under, resist that area, and then continue to break lower. So the head and shoulders pattern is essentially just a false breakout. Is this area right in here is a false breakout. So the market breaks above this area, closes above this area a couple times, and then on the retracement, it starts to show the retracement, which is expected because the market can't move in one direction forever. It starts to show this retracement, and then what it does is it breaks below this area and continues to break below this area. And then from there, it has all these traders who have their buy stops or their breakout traders, and they're seeing that this break above is a move above this area and they're getting in. It's trapping those traders and that liquidity back above this area to where they can no longer get out of their trades for either a break even or a little gain. So they're stuck holding this position and just taking their money. And on top of that, that's just number one. This area right in here is a high dealing area. First of all, the market came up to this area and created a high, then created a higher low, then came up in this area and broke above it. So this area is a high dealings area as the market, big players, the hedge funds, the institutions, all those big players are looking at this level as well because it once stopped this level of the market. It once stopped the market at this level and pushed it down. Once it breaks above, it's supposed to be respected and acting as support and to continue the trend. But if it's broken below, then they use this level as well as a place to sell the market because it closes out their buy positions as well. Once it goes through all this, they can close out their buy positions at break even and start to add their orders for the momentum to the downside. So not only is it showing you a false breakout, it is a high dealings area. And number three, on top of that, if you can also see that I talk about this, the most common pattern in the market is an impulse, a retracement, and another impulse continuing the trend. And if you look right here, what do you have? An impulse, a retracement, and continuation to the trend. So if you can capitalize on this area of this head and shoulders or inverted head and shoulders, this right shoulder, then you will also be in continuation with the trend and be into an impulse phase, which will give you your profits, will keep you in the market. It's an extreme push right into the market. It's one of those trades where you go right into profit and the market never ever comes back to your entry, even tests it, not even messes with it because it's in an impulse. The market is moving down, creating lower lows, and it's breaking below this lower structure. So you'll have an opportunity to go risk-free. You'll be in an impulse phase where the market will give you your profits immediately and it will continue the trend and it will give you one of those runners if you like to leave runners as well as that. So you have three things on top of that. Not only are you getting identified and showing a false breakout, so showing where the market is once trying to show you manipulation, it breaks above and then immediately close back below, and then it's also a high dealings area, which is the areas that you want to do your business with as well because that's where the banks and hedge funds and institutions are doing their business. And then on top of that, it's putting you in a position to be in the impulse phase in the market, so it gives you the opportunity to get in at the right area of the end of a retracement or a correction of the exhaustion of all that, and then put you into position to continue the trend and be in the impulse phase where the market clearly shows you that you are in the right direction immediately. It's one of those trades where you think you don't get a lot, which is what we capitalize on here at the FX Savant University and plug in the program. It teaches you how to capitalize on these moves and put you in position to take part of these impulse phases in the market. What this does as well, put you in one of those. So now that we have that explained, let's go ahead and show you this example here. here. So we have a NZD JPY example, and we're going to go over it the only way we know how, which is multi-time frame analysis and structure the right way. Also capitalizing on some of these patterns that we know to be true in the market. So if we do look at it on a monthly time frame, what can we identify? We see that the past 3 months, the market has came to this area and has then been rejected. Now it has given us some bullish candles, but we can see that this area right in here is an area of resistance. So every time the market has came in this area, it's pushed back down. Every time the market has came in this area, it's pushed back down. Every time the market has came in this area, it's pushed back down. Every time the market has came in this area, it's pushed back down. And now we are currently right in this area of this market again, right here. So if we've rejected it once, rejected us twice, we can expect to reject it one more time, and that's on the monthly time frame after we've had this overextended move all the way to the upside. We know the market cannot go in one direction forever. So we have that with us on the monthly. We are retesting the highs. Now, if we do look at it on the weekly, what can we identify? On the weekly, we see that we have previously broken above this area that we could not break above before. So once we did break below this area, we came back, retested it. We did reject it with the next candle. Then we failed to break and close above this level once again. And then once we did finally break and close above this level, we did not come back and retest this level yet. So on the weekly, what can we see here? We have a move down, a move up, a move down, a move up, a pause right here, consolidation. Even though the market did break up, we did break down, close right around this area, and then we finally did break up. So what can we expect? Since we did break above some structure resistance, we can expect that market to come back and retest this area as support and then only continue to the upside. And that is what would give us the highest probability in order to win our trades and take part in these longs and what would make sense in the market. So that's what we have on the weekly. Keeping our charts clean, we can go down to the daily. On the daily, we can see this example, or we can see what I just explained a little more pronounced. So we can see that we have then been breaking. Once we did break to the downside, we started to create and finally did break structure to the upside. It can only be logical to come back and retest that area as previous structure resistance right in this area and have it be structure support in order to continue to the upside. So on the daily, what do we have? We have an impulse to the upside. We know the market cannot go in one direction forever. We have previous structure resistance right in this area. This is the pattern that I talk about all the time, is we have a move to the upside, then we have a retracement, we have a move to the upside, another retracement, and then we break structure all the way up to the upside, giving us an overextended W formation. What can we expect? We can expect a retest of the neckline, which is right in here before we continue to the upside once again. So we have that on the daily. Now, even though we do have a extreme bullish sentiment and momentum to the upside, we are retesting the highs right in this area where we have been rejected once again. Now, this is when we get into talking about the head and shoulders formation. We've recently been testing the highs, correct? Correct. Now that we've been testing the highs and we've tapped into that area, we can look for the reaction and see if we can capitalize on what has happened once we've entered into that area. So we know that these are the highs up in here. Once we entered the highs, what was the path of the market? We had an impulse to the upside where we found some resistance. We had some consolidation right in this area, and then we broke above that area, and then after that we immediately broke back into this previous structure resistance that should be support, but we broke and closed below it. So what can we expect? We can only expect that from this move up, move down, move up, and move back down, we can expect that if the market comes back and retests this left shoulder, we can expect it to be resistance and the market continue to the downside and only to create more bearish momentum. If we look at it, and I just draw it out, we have a left shoulder here, we have a head, and we have what should be expected to be the right shoulder. We should not see the market break and close above this area. If we do, we have a failed setup, and then we're no longer looking for the short. So with that said, on the 4-hour time frame, what do we have right here? We have the market that has created some resistance in this area. It's broken above it, came back, closed below it, back immediately in the area. We do not have any candles of a different color other than this black candle. So we have extreme bearishness to the downside, creating an impulse. This one candle engulfed the previous 2 bullish candles that broke and closed above the resistance, and this bearish candle closed below it. So we can expect that this area to be acting as resistance, and that's on the 4-hour time frame. If we do drop down to the 1 hour, what can we identify? That we have an impulse to the downside. So after we have an impulse, we can take our Fibonacci tool from the high to the low, and we can look for areas of importance that the market will encounter where if the market does want to continue to the downside, which is the trend. So we have taken our Fibonacci on the high to the low. We want to expect bearish continuation. These are the levels in the market: the 382, the 50%, and the 618 and the 786. The 618 is the golden ratio, which does line up perfectly with the resistance that we do have drawn out on the 4-hour time frame. This is our left shoulder, our break above, and our close below. On the 1 hour, we do have a little more detail, but if we do take our Fibonacci on that, we can see that we do have levels of resistance in the market that we want to see the market continue to respect and continue to the downside. So on the 1 hour, we have everything lining up. If we do play it forward, we have the market that did retest the 786 but got rejected, and we are starting to create some moves to the upside, getting rejected by the 786 once again. And then we have a break of structure. So we have a break of structure indicating that structure trend, lower lows, lower highs, lower lows, is continuing. On the hour, we do have a big break, a wick testing the downside, which is the candle. We want to see the next one fill in the wick. We do have some rejection right around in this area. If we play it forward, we finally get the break below this area, which is market continuation. So we are starting to break below and continue to break below lower lows and create lower highs on this market. So if we look, we have the market that pushed down and broke all this structure. On the retracement, then we do have the move that finally got rejected to the downside, breaking structure. And then on that retracement, we did come back and create a lower high. So the market failed to break these highs up here, created a lower high. And then next after that, we created a lower low, breaking below these lows right in here. So what can we expect? We can expect a lower high to be created because now we are in a bearish structure formation. So let's play it forward. Still continuing structure. And then I think we drop down to the 15 minutes. So right around here is when we go over to the chart. So if we pull it up, we have NZD-JPY right here at 5:24 a.m. We did have the sell at 78.78, stop loss at 79, and a take profit at 78.06. So if we hop back on the chart, what do we have here? 78.79. Let's go ahead and set this up. 78.78 entry price, 78.06 is the profit level, and 79 is the stop loss level. So what are we looking at on the 15 minute? So if we drop down on the 15 minute, what do we have here? So right before we started to look for an entry into this trade, we were following the market, and we had the market continuing to make lower lows and lower highs. So we started to break structure down in here. We consolidated a little bit, and then we finally broke that structure, came back, retest some of the structure, started to retest and stay below this resistance that we found. We came back, retested it, and then what we did is we came back up and retested it once again, creating a double top. So we came in this area, pushed down, came back in this area, and we're starting to push down once again. If we play it one more, because we are looking at 5:24, so we can play it. This is 5:15. So on the next candle is when we were probably looking to enter on this market. What do we have so far? The market coming back in this area, failing to break above this little resistance that we did start to find right in here. So once we found this resistance in here, we weren't starting to break above it. What we did is create this candle here, which is the next one that we want to see fill in the wick. So on this next candle is when we entered into the market, and you can see that we got triggered, and then from there you can see we have the stops above the high, and what we're expecting is a move back down to this area, because if we do look at it on the daily time frame, didn't mean to expose that. What can we see? We have an overextended W formation, and we should expect that the market should come back and retest the previous resistance and should now see it acting as support. So we can look for the market to come back and at least be attracted to this area here. So take our take profit from our higher time frames, and we take our stop loss from our smaller entry time frames, just getting a stop loss above the highs, because if the market breaks above this area, we don't want to be in the trade anyway, because it's no longer confirming our bias. We're creating higher highs and higher lows. We don't want to be in a sale when the market is doing that. So if we do play it forward and just let it play, you can see that we are triggered. The market does start to make a move to the downside, risk free. So if the market comes all the way back, doesn't really matter. We're risk free on this trade right now, risking a 3.2 R, which is a 71.6 pips, risking about 22.4 pips and looking to have 3 times the risk met. And you can see that the market does go ahead and smash take profit on this. So nice and easy using the head and shoulders pattern that we found right in here. If you would like to learn how to capitalize on moves like this, you can go ahead and check out the program. It will be linked down in the description. I think the program is a really full program. In the program, you do get access to me where I answer questions every single day that you submit. You also learn all the details and intricacies of all the strategies that I use to capitalize on moves in the market like this here, as well as you have the opportunity to trade with me every single day, getting the exact pairs that match the strategies to the T, also getting the exact entry, take profit, and stop loss on all the trades that I take. I do think it is a full and complete program. So check it out, link in the description down below. But other than that, I would appreciate it if you did learn some valuable knowledge from this video. Go ahead and drop me a thumbs up. A subscription would be pretty nice as it does help out the channel. Other than that, I hope you have a profitable day on and off the charts. And until next time, I holla. Why can't I speak? That's crazy.